Hey everybody, it's Randy Wolfe. Welcome back, and this is video number 5 in our 12-part video series. So if you have not yet, be sure to review the last 4 videos so you can see what's going on and be up to date here. But in this video, we're going to talk a little bit about how to analyze a deal in under 10 minutes. You don't need to be a math genius or spend hours with spreadsheets to analyze a real estate deal. In fact, I'm going to show you how to break down a deal in less than 10 minutes so you can know whether or not to say yes or to walk away. So let's dive in. So it's important to understand why being able to analyze deals quickly is a huge advantage to you as an investor. You know, speed equals opportunity, and the better you get at this, the more deals that you can review. You've got to be comfortable underwriting deals, but you need to be doing it at a high speed before you really dig into the numbers. So let's kind of talk about the rule of thumb and sort of what you need to be looking at whenever you're analyzing a deal. First of all, we have the ARV. ARV stands for after repair value. What will this property be worth whenever it is completely fixed up? Now, in order to calculate the ARV value, you're going to use comps, not guesses. And a good place to start with this is Zillow. You can start on Zillow and just do some market research in the zip code. You can look at properties that have sold recently near your subject property, but you ultimately do want to dive a bit deeper than just Zillow. One of the tools that I use quite often is a tool called PropStream. I'm going to put a link in the description below, but as you can see here, I've got a couple of screenshots that you can see when I've used PropStream to analyze a deal. There is a comp section. You can actually click on that. You can go through and sort through properties that have sold on MLS as well as properties that have actually sold off the MLS, and it shows you an average of these properties, so the average sales price, the average that they've sold for, price per square foot. PropStream has been a great tool that I've been using for years now, and if you're interested in that, I can get you a 7-day free trial. Like I said, link is in the description below. But the ARV is definitely a number that you must be really good at calculating and know exactly how to do that. So that's what you're going to do, is calculate the ARV. Next, you're going to calculate the estimated cost of repairs, and you need to be able to do this very quickly. I have a worksheet that I have created, and I will be happy to share that with you, and it basically is broken down by square feet. So you can look at a square feet of a property, and then it's broken down by the type of renovation that you need to do. So if you're interested in that, I'll also put that link in the description below, and you can snag a copy of that. I actually use this sheet in my private community with my students and people that I mentor, but this sheet is great. It gives you a really quick way to estimate the repairs quickly, kind of tied into the price per square foot and how in-depth the renovation is going to be. Again, this is just an estimate though. This is not something that you can rely on 100%. You ultimately would need to get a contractor out there to take a look at the property later in the due diligence phase. But again, it's a great way to estimate the cost of repairs. Now, if this video is helping you feel more confident in analyzing deals, hit that subscribe button for me. And don't forget to check out my private community. It's where I personally help people break down deals just like the ones that you're potentially looking at every single week. But once you have factored in your ARV and once you've factored in your estimated cost of repairs, what you need to do now is calculate your all-in cost. So this is purchase plus repairs plus closing plus holding costs. So you don't want to forget about things such as taxes, utilities, the interest you're going to pay on your loan. All of those things are typically things in the beginning when someone's just getting started out, they forget about. They don't think about those things. And if you leave those out, that can definitely eat into your profit. So you want to make sure you calculate your all-in cost. A good rule of thumb is whenever you're looking at a flip or a BRRRR, you typically take 70% of the ARV and you subtract out repairs, and that is a good tool, good way to kind of give you an idea of around what you should be offering. The 70% rule is the ARV times 70% minus repairs, and that's going to give you your maximum allowable offer. That's very simple and effective. Now again, this is a good rule of thumb when you're making your offers. Ultimately, when you do your full underwriting and due diligence, you may need to modify this, but it's a very good rule of thumb to analyze whether or not something is in the ballpark of what you need to be paying for. Now, if this is going to be a property that you're going to rent out or BRRRR out of, that sort of thing, you want to be sure you break down the projected monthly rent. All right, cash flow. This is very important to you as an investor. Now, there are a series of tools that you can use. There's paid tools like Renometer, but Zillow also has some tools you can look at and look at rentals, what they're going for in their area. You can speak to local property managers factors just to kind of validate your numbers, but definitely want to know roughly what you're going to be able to get as far as monthly rent for the property once it's fixed up. Now, if your property is going to be a rental, a good rule of thumb, again, just a rule of thumb, not the gospel truth now, but a good rule of thumb is to calculate expenses using the 50% rule. And so in essence, if you are bringing in $2,000 per month and you have a traditional mortgage, basically half of the rent is going to go to expenses. So this is things like your mortgage, and this is things like repairs, all of those things, and everything that's left over after the expenses is your pure cash flow. So again, this is just a rule of thumb. This is not for sure. You have to do full underwriting ultimately. But when you're just trying to get quick estimates, usually if the monthly rent's going to be, let's just say $1,500 a month, you can estimate somewhere around $750 a month in actual cash flow. And again, that is if you're putting down roughly 20% on the property's loan. If you finance roughly 80%, then that means you should be in that range of about $1,500 rent should bring in about $750 or so, give or take. Now with interest rates, since they have gone up, that has gotten a little tougher and oftentimes a little bit tighter, so it might not necessarily be 50% with the interest rates where they are, but again, it's a good rule of thumb that you can kind of estimate to see where you are. If you put down a higher down payment and you finance less, obviously it's easier to get closer to that 50% rule. You want to be sure that you run your numbers, so net cash flow and return on investment, those sort of things. How much are you making monthly, annually, based on what you put in? A good number percent to look at, or a good indicator, is what's called cash on cash return. Let's just say if you had to put $10,000 down on a property and ultimately it's $100,000 property, you end up making $10,000 in rent that year, let's say if it's a short-term rental or something like that, then your cash on cash return is 100% because you have made back 100% of the actual money that you had to put into the deal, the cash. So if you put down $10,000 on a property and you only ended up making pure cash flow of $1,000, then that means your cash on cash return was 10%. And this is a good indicator to look at because oftentimes if you compare your real estate investments to like the stock market, it gives you a good benchmark, good idea to compare to how the stock market's doing versus your asset, how it's performing. But keep in mind though, unlike the stock market, you have a lot of other great benefits with real estate. You've got a lot of tax benefits, you've got the ability to leverage, and so it's a good thing to look at, but don't get too caught up in cash on cash, because sometimes if you're investing in an area where, let's say it's a high appreciating area, your cash on cash may be lower, but your appreciation may be a lot higher. It's a good idea to have a deal calculator or like an analyzer spreadsheet that you can look at. That's important. If you take a look at one of mine that I'll show you, for example here, this is my offer sheet, and this is an example of a property with an ARV of $425,000. 70% of ARV minus repairs, and I'm estimating the repairs at $85,000, puts me at a max allowable offer of $212,500. Now in this is actually a real deal that I was looking at the other day. My actual price that I was trying to land at was $200,000. If you look at my closing cost, I've got those factored in. I've got my selling closing cost. I've got my hard money loan. I've got my origination cost, my monthly cost of the debt. I have in there estimated 6 months. So I'm looking at my payments. I'm looking at my taxes, insurance, utilities. I have a little bit of a contingency in there. So basically this project over 6 months, my total amount of money and expenses I would have would be $71,503 that would be going into this. So that gives you an idea of how important it is to really know your numbers. Now at $71,503, if I got it at my price of $200,000, my total cost all in would be $156,503, and that's including the repairs and everything. If I sold it at $425,000, that would give me a profit of $68,497. So I'm hoping that I get this deal, but we're still in the negotiation. But that just gives you kind of an idea of a deal analyzer sheet that I use. I have this little calculation, and I will put in the description below, I'll put a copy of the estimated repairs. But as far as a deal sheet, you can actually kind of create one of these on your own, and it does depend wherever you're investing. Things like taxes and insurance, that sort of thing, would vary from location to location. Once you have run all the numbers and have all the information that you need to know when to walk away, even if the deal feels good. Oftentimes we get emotional, we get tied into these deals, we really want to make them work, but if the numbers don't make sense, you have to be willing to walk away. Stick to the numbers, try your best not to get emotional, because I'm telling you, when you have something and it's real close, it's very tempting to push the numbers and try to make it work, try to fit that circle in a square peg or vice versa. But but you got to stay disciplined with this sort of stuff. You know, once you get the feel for this and you get good at this, you're able to do this a lot quicker. Certainly, you can get to a point where you can analyze a deal in about 10 minutes or less. That way you can get high volume. Once you're starting to generate leads and having a lot of opportunities, it definitely makes it a lot easier. Once you can analyze deals, the next big question is, where in the world do you find them? And in the next video, I'll show you how to uncover the best off-market deals even as a beginner. I want to get you sourcing these opportunities, get you some deals going. So I hope you've enjoyed this video. Please be sure to subscribe and click the notifications bell so that you can be updated. We have more videos in this series coming out, and I hope to see you on the next one. That will be video number 6 in the series.